Vibhav Kapoor, Group CFO with IL&FS, who joins us live on the show. Vibhav, good morning and thank you for joining us. Vibhav, December has been a good month for Indian markets. We've seen all-round participation. Individual stocks have done rather well. But some would argue that December is history. Let's talk about Jan. And in the month of Jan, we are pitted against two important events. One, earnings, and second, global macro.
Yeah, I think things have improved a little bit for the markets in general. The global markets have been pretty strong and they have taken the beginning of the tapering pretty well. And India is now more prepared for tapering than it was 6-7 months ago. More than all of that, I think the earnings are gradually catching up with the valuations, because if you really look at the indexes, it has been range bound for a very, very long time. And meanwhile, earnings have been catching up at 7-8-10% every year. So valuations are no longer outlandish. They are reasonable and they are maybe even attractive a little bit if you look at a 12 to 24 month perspective. And therefore, the base of the market, I think, has gone up. Now, as far as January is concerned, we have, as you said, the earnings, which I think will not surprise on either side, but, you know, the markets have gone up substantially from October when the last earnings came, and therefore you may not expect the market to react too positively to earnings, except in, you know, certain specific cases. And then global macro, I think, as far as tapering is concerned, that's out of the way for the time being at least. I think the other important event in January is going to be the RBI policy and the inflation numbers. And because that, I think, is one issue domestically which is still very critical from the point of view of how the markets progress going forward. Because if the economy has to really take off, interest rates have to come down. And for that, inflation has to come down. So that's a critical number which we would be watching out in January.
Vibhav, since the market is now divided into a timeline being pre-poll and post-election, given the parameters that you just talked about, what's the sense that you're getting? Is there a case that the market could break above the 6,400 high and we could see levels like a 6,700, 6,800, or some people are even talking about a level of 7,000 on the Nifty?
I think probably if there are not further too many interest rate increases going forward and the global macro remains steady, which I think it should, then pre-poll you could see the market moving up gradually. I don't think there's any breakout type of situation which we're talking about. I think gradually this the upper end of the market can go up from 64 to 65 to 66, maybe even 67 by the time the polls come around. And then, of course, if we are looking at the post-poll scenario, it's almost impossible to say. In fact, for all of 2014, I think the most important, or rather the most critical event we have are going to be the elections, obviously. And it's really difficult to say what's going to happen there and how the markets will behave after that. But I think pre-poll, by and large, the market should remain steady and, as I said, maybe move up gradually by April, May to 66, 6,700 levels.
The one point that you just talked about, Vibhav, it being that inflation, what the RBI action is of utmost importance. While it was status quo this time, if inflation were to remain at elevated levels, is there a chance that mid-Jan we may see a move from the RBI to hike interest rates? And if that were to happen, how negative would the markets react?
My sense is that you are unlikely to see a rate hike in January, simply because, as the RBI governor said, a lot of the last increase in inflation was due to vegetable prices, and at least for the time being they have come down quite substantially. So you will see lower inflation numbers both on the CPI side as well as the WPI in January. And since the RBI did not go for a rate hike last time, I don't see any reason why they should go for a rate hike in January if the inflation numbers start trending down or come down a little bit. So I think it's unlikely that you'll have a rate hike in January, but that does not mean that this is the end of the rate hike cycle, because vegetable prices, etc., can be pretty volatile, and they normally tend to come down in the winters. Also, we have the issue of core inflation, where also the RBI wanted to see a fall, or at least not a further rise. So I think it will be over the next 3 to 4 months that you'll really get a sense of whether we are reaching the top of the interest rate cycle or not, and that's difficult to say at this point of time. But January, I think, is going to be unlikely, and therefore the markets will probably, celebrate that throughout January and maybe February.
Vibhav, the global outlook for growth for 2014 is rather sunny. US economy, which was considered as the biggest liability for the world economy in 2012 and 13, now promises to be the biggest growth engine. So now that globally things are looking up, do you think the classic defensives and safety trade could take a backseat? So names like IT, consumer names, pharma names, do you think they could underperform for 2014?
No, in fact, the fact that the global economy is doing well and the prospects are good, particularly in the US, maybe even in Europe, I think things are improving. Japan, things are improving. These things are actually pretty good for, the IT sector and the pharma sector. So I don't see them underperforming, although IT stocks and pharma to some extent have really outperformed in the last few months. I think their good performance should continue given the fact that the global economic scenario is improving.
So on top of a good 2013, do you expect a good 2014 for IT?
I think as far as the fundamentals of the IT industry are concerned in terms of global demand and emanating from a better global economy, particularly in the US and Europe, yes, I would think that the IT sector should continue to do well. Of course, the stocks, as I said, have had a good run-up, so you may not see that sort of a return which you saw in the last few months from the IT sector. But all in all, I think you will still see some reasonable appreciation during 2014.
What's the sense, Vibhav, that you're getting about the pharma pack, though?
I think pharma also, it's a similar case. An improvement in the global economy helps pharma companies, particularly those companies which are selling generics in the US and European markets, and quite a few Indian companies are doing that now. The pharma sector had a little bit of a setback in the domestic market because of the price control order, but that's behind us now and has been factored in. So pharma is more of a specific sector than any other sector. It's more company specific than the sector as a whole. So I think companies which have large presence in the US markets and which continue to bring in new products, I think will still continue to do pretty well over 2014.
Vibhav, so where is value in this kind of a market? Because what is growing is already expensive, and what is cheap is not worth visiting.
That's a good point. You see, if you look at value from a typical traditional point of view, obviously there is value in, let's say, the banking sector, particularly PSU banking stocks, maybe in some second line capital goods stocks. But as you rightly said, right now things are not looking too good for these sectors, and therefore you may not see any immediate big bull market beginning in them. But if you have a longer term scenario, or if you look at the longer term scenario, I think these are the sectors which should ultimately give you pretty good returns, but the timing thereof you cannot be certain of, and there could be a risk in between of losing 10-20% of what you invest in. But from a typical value perspective over, say, a 3-year time frame, I would think these are the sectors to look at.
Vibhav, off late, auto-related themes have been playing up pretty well. Tire stocks, for instance, do they interest you?
Well, I think auto in general, again, The two-wheelers are still doing pretty well. The four-wheelers like Tata Motors and Maruti are still finding things difficult in the domestic market. Auto parts companies or auto component companies, I think, have a brighter future in 2014. Again, partly because the global economy is going to do better, and a lot of them are very large players in the European markets, for example, and I expect the European economy to start improving from here onwards, and that should augur well for auto component companies.
So, Vibhav, out of the three most powerful and visible themes, the three R's, rupee, recovery and rural, which R would you align with?
Well, you really need to see recovery because as far as rural is concerned, yes, it's a great long-term story. But if there is no recovery in the domestic economy, at some point of time you will see rural also slowing down. There are already some signs of that happening. So rural is actually to that extent a subcomponent of the recovery theme. The rupee is always good when it depreciates for certain sectors, and we saw that as far as IT and pharma are concerned, and maybe some of the other export-oriented companies. But that's a very limited sort of game. So the real one you have to really bank upon if you think that, if you want to really play upon the Indian markets in totality, then it has to be recovery.
Let's look at benchmark indices. 42 points up for the Sensex, and which honestly is not a bad start. When we walked into trade this morning, SGX was down by 15 points. Right now, what do we have? An uptick of about 15 points. So in terms of a variation, it's a 30-point variation. That's about 0.5%. 0.5% is not bad. Today's expiry, you could see a touch of volatility, but with 2 trading sessions left for this week, 4 for the year, news flow is dried up completely, volumes are broken down or volumes are down, and the flows are also not that strong. We may just hang in there, and which honestly is not a bad outcome. You close above 6,300 for this year, you would be closing at a record high, and there is no way anyone's going to complain if you close above 6,300 for the year. And Vibhav, I think that's the bottom line. Who would have thought 3 months ago we would go anywhere close to 6,300 on the Nifty?
Yeah, that's true, but a lot of that got aided by the rupee depreciation because if you look at the index, a lot of the index is dependent actually upon export-oriented companies and export-oriented sectors, at least 35-40% of it, and the rupee depreciation actually helped those companies and therefore brought the index up significantly. Also, as I said earlier, the index has actually been range-bound for such a long time. I mean, 6,300 or 6,350 was first touched in 2008 January, so we are 6 years thereon. And therefore, over a period of time, particularly the last 1.5 years, the earnings have sort of caught up with the valuations. And today, let's say an index of 6,000 or 58, 5,900 looks actually cheap if you look at the components of the index. Whereas a year ago, 58, 5,900 looked expensive. So that's the reason why the index has gone up to the levels where it is today. But unfortunately, that's not been corroborated by a real economic recovery or by the broader market. Yes, a lot of stocks in the broader market have gone up in the last 2-3 months, but then a lot of these stocks fell, 100% and have gone up 20%, which is not all that great a thing.
So, Vibhav, why is that happening? And that is what I keep on debating with every expert on the show, that we've seen 2 years of single-digit growth, not even double-digit, single-digit growth, but the P multiple in some stocks have expanded. So if earnings are not growing, why are P multiples expanded? And if the India story is not so robust, why are foreigners so gung-ho about investing into Indian stocks?
Well, that's exactly what I'm saying, that I don't think the P multiples have really expanded, except for some companies which are more of global-based, export-oriented companies. And there, of course, one, the rupee depreciation helped, and the fact that the global economic recovery is underway has helped these companies both in terms of their earnings as well as in expansion of P multiples. Also, as you said, while there has been only single-digit growth, but it has been in the region of 8-9% for 2 years, And in 2 years, that means almost 18 to 20% growth in earnings. And an 18 to 20% growth in index. So if you discount that by 20%, you would actually be only at 53 or 5400 today. So the 53, 5400 of 2 years ago is equal to the 61, 6200 today.
Vibhav, I know you normally refrain from talking stocks, but since this is our last show for this year, let's be stock specific. Give me some stock names for 2013. Give me a hint. Spill your beans.
Well, as you rightly said, I really don't, I don't normally want to talk of stocks, but if you look at 2014 as a whole, I think there are some companies in some sectors which are not directly economy related, because I'm still not sure of the economy, how it will do and what will happen in the elections. But some of the non-economy related companies which have been range bound for quite a long period of time, but where earnings have been growing reasonably, if not very strongly, over the last 3-4 years, are looking pretty reasonable now, I think, and should perform well in 2014. These could be companies like Reliance, for example, which has been range bound for a very, very long period of time, or some of the telecom companies like Bharti, where again, the stock hasn't gone up or hasn't done much, but earnings are slated to improve because competitive intensity is reducing, and the telecom sector is not all that dependent upon what happens to the economy.
Vibhav, so good to have you on the show.